I almost don't want to turn it off. This is my working music. I listen to the classic music all throughout the day, but we're going to have to get down to business here. So let me turn off my music. You can hear that, right? It's beautiful. Good afternoon to those of you in Europe. Good morning to those of you in the continental United States of America. Welcome to my humble abode. We are going to be going through the market today. I know I spend a lot of time talking about my pet project, which is helping people that live in both countries. But today we're going to talk a little bit about the meat and potatoes work of what we do at Green Ocean Global Advisors, and that is talking about investments. Raise your hand if you think this year is going to look just like last year. I mean, 2025. Is it going to look the same as it did in 2024? Of course it will, because everything's the same. Thank you. I like to see all the hands going up actually, because there's nothing to be worried about. There is actually quite a lot of interesting stuff that's going on in the world that we can all look forward to, whether you think so or not. So today, that's what we're going to be talking about. We're going to be talking about the playbook for 2025. Um, Again, give that little clicker a squeeze if you think that this year is going to be awesome. If you think there's lots of good things to look forward to, um, I think you might be surprised. Actually, there's a lot of interesting things afoot. Before I get started, my legal team has told me that we have to tell you that all of this is just for fun. Basically, everything that we are about to go through, as researched as it is for informational purposes only. So it does not constitute personal financial, tax, or investment advice and should not be relied on as such, et cetera, et cetera. In other words, come see me one-on-one if you want to talk about what we are really doing for individual investors. If you don't know me, I don't know how you found me here today, but welcome. My name is John McNertney, and I have a certified financial planning designation, I think for about 12 years going now. I started way back in the old days for Merrill Lynch, Pence, Fenner, and Smith at 601 California Street in San Francisco, California. But these days, I split my time between there. I was there 2 weeks ago, and in Portugal, where my family has made our home. I won't go into the rest of these details, but again, you can come and find me if you'd like to know more. Today, we're going to talk about investments. Boring stuff. We're going to talk about what was, so we'll talk about the last 4 years, and then we're going to talk about this little thing called the US election that has just concluded, and what types of impacts it may have on the stock market going forward. I talk about the economic agenda of the incoming administration. We're going to talk about the framework for how these things influence markets, and then we're going to go through my boring playbook for what will be interesting, in my humble opinion, about the new year. But as a housekeeping note, although I will be talking fast and hopefully not too loosely through this slide deck, I want you to participate if you can. Please do ask questions, throw comments, don't throw bombs, unless you think it's constructive for the rest of us. If you have a question, I guarantee you that you are not alone. Other people will have the same exact question as you. So please, please, please do that. And reach out to me after this short event if you want to know more about any of the things that we talk about here today. Fair enough? We've got one in the Q&A. No bombs. Thank you, Michael. Okay, so just remembering that knowing about where we have recently come from, I think, can be of some value. So really quickly, just to jump in the Wayback Machine, of course, we have come out of COVID just about 5 years ago. Has it been 5 years so far? I think it's only been about 4 years ago. And so we've been enjoying a nice recovery. After the stimulus and all of the Fed bailouts that occurred during that period, we've been trying to get back to normal, basically. Central banks have indeed been tightening monetary policies. Our very own Fed in the United States of America has been increasing its interest rates substantially over the last several years in an effort to tame inflation, because inflation, as we all have felt, was absolutely miserable from 2020 to most of 2023. But that has improved dramatically in the last year. Geopolitical tensions have been amplifying the European energy crisis, not as much as Russia wanted, but it has definitely been disruptive to energy and food prices in Europe. And so Europe hasn't really come out of its normal stuck in second gear mode over the last few years, and we'll talk about why I don't think that that's likely to change in the near future. Policy changes have affected key industries such as energy, healthcare, and technology. It's probably going to be a continued drumbeat in the future. And markets for 2025, not to steal my own thunder here, but they're looking pretty stable for now. We need to balance our need for growth in our portfolios with a foot on the brake if indeed things do not go well. So, what do we have to look forward to? Well, we have Donald J. Trump as the once and future president of the United States of America. Mr. Trump is the 47th president. And Republican leadership has assumed the steering wheel in both the House of Representatives and the Senate, in addition to the executive seat. And why not mention that we also have the judicial branch of the government colored red now as well. So we are all sort of on the same page with regards to that. Investment performance in 2024 as we go into the end of the year. What a year for Bitcoin enthusiasts. Is that you? It's not me. I mean, I'm old now, and so I don't know what a Bitcoin can do. I don't know if you can buy a pizza with a Bitcoin, but you can apparently make a whole lot of money in 2024 if you're invested in things like Bitcoin, in gold, and of course, the rest of the market has followed suit. With the S&P 500, particularly the technology stocks, really, really killing it here in 2024. But since we're here to talk about what the incoming administration might mean for investors, let's get busy talking about the incoming administration's agenda. So we're talking about the normal healthy stuff is what the Trump administration has said that we are going to be focusing on. We want a strong GDP, which in the words of their spokesperson is 3% GDP. So we want to get good GDP growth. We want to reduce the federal budget deficit to 3% of GDP. I'm not so sure how we're going to accomplish that, given some of the things we're about to talk about. And we want to increase domestic oil production, both to strengthen our domestic economy as well as to continue to reduce our reliance on foreign energy. So nothing dramatically new there. We want to reduce corporate tax rates and we want to implement tariffs as well. I'm not going to ask for a show of hands if you want to see those happen, like right now. But the reduction of corporate tax rates is my first place that we want to go here because it's an interesting element in the incoming administration's wish list because it has actually accomplished this before. In 2017, the Taxes Jobs Recovery Act enabled a reduction from 35% to 21% for corporate tax rates almost across the board. And so that is what we are going to be looking to add to this year with a reduction from 21 to 15%. Could be very, very stimulative initially because companies will be able to increase profits, which is, of course, what we are investing in when we invest in the US stock market. So US companies are actually likely to get a nice immediate boost from this if, of course, it passes, and that's pretty nice. So if you're investing in domestic companies, especially financial companies, you could actually see a nice little extra boost to your investment portfolio from this, as the potential benefits make their way through the economy. The criticisms here, of course, is that initial estimates predict a reduction in taxes revenue. Revenue. Of course, we're going to see huge reductions in tax revenues, because that's what we're doing after all. And so that could, of course, increase the deficit to levels that are even higher than our current epic levels of annual deficit. Tariffs. The incoming administration has made no bones about this one. We could see upwards of 100% tariffs thrown onto the non-favorable countries that we currently have as trade partners. So the Chinese and Mexicans, especially, are looking at anywhere from 60% to 100% additional tariffs on goods making their way into the United States. And of course, it can only be inflationary. Most companies are already chiming in to talk about the fact that they are going to be increasing costs. They've got to make up the difference somewhere, and so that will put some pressure on the U.S. consumer, and that will be key in areas like agriculture, manufacturing, technology. And so this will probably not show up immediately. Remember, all of these factors have something of a lag time involved with them, so we will likely see this develop as the case continues here. That's not a pretty picture, but it's the only one I could find that had all of the key actors that are going to be helping with this. It will, according to a lot of economists, this tariff decision will, it's thought, have some pretty profound impacts on our gross domestic product. It can't help but hurt our GDP because it's going to bite into everybody's wallet share. So everybody from Moody's to the IMF to UBS are thinking that there may be a 1 to 1.5% reduction in real GDP, which of course it conflicts with one of the first mandates that we just looked at. And we'll set the stage for some tension, of course. It's just inevitable as we head through this during this first year. We had a question that is actually very relevant here, which is there's companies that make their products only in America, and those companies are actually rare these days. We have seen a lot of onshoring of U.S. companies that have formerly used mostly Chinese manufacturing. But it's not as robust or as unilateral as we might like to see. But those are the companies that the Trump administration has been saying that they will be targeting with reduced tariffs. Any question there? Again, guys, jump into the chat, jump into the Q&A if you have questions. I'm just going to revisit the chat. Okay, we don't have anything here. But that is again, it's one of the riskier sides of what we're looking at here. One item that I am actually very wary of is the tensions with the Federal Reserve. Jay Powell, just a few weeks ago, was asked whether he believes that his job will be threatened, and there is no legal grounds for this, but the president is, after all, the chief executive, and so if he wants to, he has indicated he is interested in reducing the autonomy of the U.S. Fed. And you don't need to look very far if you want to do some reading on this, to note that it would not likely have a good end. There are a variety of reasons that it is very useful to the U.S. To have an autonomous Fed. And so this is the least likely, I think, of all of the incoming administration's bright ideas that will come to fruition. And here we have just the first few rounds in the tweet storm that we are likely to see in the next 4 years. Now, this actually is really interesting. If I were to poll you and ask you what administrations you think would preside over the best stock markets over the years, I would get mostly answers that are in line with whatever your political affiliation are. Over the last few weeks, I've been studying some research papers that indicate that most people vote their opinion. And the problem with opinions is especially when it comes to politics, is everybody can't be right. And so most independent surveys that are done actually show that people vote with their dollars. They tend to reorganize their portfolio in ways that are aligned with their politics. In other words, I've had clients call me before presidential elections. Oh my gosh, my person is not going to win. Can we please sell everything? Um, Obviously that rarely ends well, and in particular if we don't have a good relationship and I'm not able to bring some sanity to the discussion, things just go worse from there. But the statistics don't lie. Is that Democrats tend to preside over much stronger stock market growth. The most notable recent example being the Trump administration's first 4 years. They presided over about a 14% growth rate over their 4 years. And the Biden administration was closer to 9%. So the Biden administration did not actually fall in line with this. But going back to 1947, the Democratic Party has had a much better, a much better track record, which you can attribute either to luck, you can attribute to the outgoing presidency, you can attribute it to what you will. But most often it is the Republican Party that speaks loudly about being fiscally conservative, but then behaves in ways that is anything but, which is something that we certainly may experience in the next few years. Somebody in the question and answer pointed out very rightly that the Republicans and Democrats are not the same in character as they were in decades gone by. That is for sure the truth, and that is why I think the data is more important than so much of what we're looking at here. Um, Vanguard is predicting that we will see some strong GDP growth this year, with the U.S. At the top of the list once again. China may get back in gear. China has been having a really miserable few years here as they have been trying to kind of chew their way through a recession and the overgrowth in their housing market that they spent a lot of the last decade putting together, and now they're kind of falling on their own sword. Um, and so what I'm really interested in here is seeing unemployment continue to remain low, and of course, inflation remaining low. These do tend to be, they remain the best predictors for continued economic vitality in the United States of America. And so as we think about the psychological impact, just take a deep breath, I think is really what we must do. Investor anxiety is driven by the uncertainty, which is almost always with us. And recency bias is a thing. So those of you that know anything about me know that I love investor psychology as a subject, and it has a huge effect on us. So recency bias means simply what? It means that we think that what has recently happened is still likely to be the most likely thing that happens, which isn't actually the case. So the thing I'm thinking of the most here is the S&P 500 has been the only game in town for about 15 years. And so the trouble with that being the case is that a lot of us are getting accustomed to the thought that that will always be what we have to look forward to. 10% S&P 500? Yes, please. I'll take another, and then another, and another. And so that's recency bias at work, is thinking that despite the long-term averages where we have some really awful years, in addition to the great years that we've seen, that we'll just keep seeing more of the same. We need to focus on what's right for us in the long-term view. And that is that's part of my job. So what does the data really tell us? Well, the data tells us that labor is looking good. So even assuming some revisions that we always see from economists, payroll growth is looking awesome. So the US is on a stair step right now. Stair step to better and better and better labor conditions. This is non-farm payrolls. And a recessionary yield curve inversion would show us this little teal line right here. This is an average recession in the eyes of the economists that look at payroll numbers. We don't see this in sight. It's not happening. So we think about like what we may have loved or hated about the last month in politics, doesn't really show up in the data. Even assuming, again, these revisions, payroll growth doesn't look recessionary on construction. And construction, is it meaningful? I would say yes. In fact, construction, industrial, and now increasingly, unfortunately, well, fortunately if you're in tech, but technology, um, the job growth that we're seeing in everywhere except for tech right now, I don't have a chart for that, but it doesn't look like at all recessionary. And construction jobs, which we think of as a source of truth, construction payrolls are still at their what we call cycle highs. So if you're in the US right now and you're looking around, you will see that there's lots and lots of building happening. And now many Americans have the president that they want. Whether you agree or not, a lot of people are actually pretty enthused about the potential that's represented by somebody uh, that a lot of us Americans think of as an underdog that is going to blow the gates wide open again. So mortgage applications don't suck much. Sorry, that's not the economist's word for this, but mortgage applications. So mortgage rates are not super low, and applications are not super high either, but they have been trending higher, and this could represent pent-up demand. Existing home sales are about as low as it gets right now. And so you could look at that in two ways. You could say, oh, bummer, I hear you. I've been trying to sell my house. Or you could look at it this way, as soon as interest rates and the sort of long and variable lag that Jay Powell is always talking about take hold, interest rates coming down is going to give us a breath of fresh air. It's going to happen. It hasn't happened, and it's got to. And the data shows us that the S&P 500 has also got a form of pent-up demand in the form of stocks that aren't doing well. And by that, I'm thinking of stocks that are anything but tech stocks. 2024 was the year that we all thought that computers were going to come and take our job. So that means that everybody has been buying these stocks. Everything from Apple, Qualcomm to, of course, the top dog, NVIDIA, have been crushing it. And that has resulted in what we think of as the worst equal weight bull market ever. In other words, the S&P 500 is two separate things. It's the top 7 stocks, and then it's everybody else. And so when we look at like the pricing on these things, the Mag 7, the big tech names, have just completely gone over the moon, and the rest of the stock market hasn't been keeping up. In fact, if you're investing in tech stocks right now, you are looking at some of the most expensive price to earnings multiples that the US has ever seen in stocks. And that doesn't always end super well. So, you may want to think about diversifying away from that. So, you with me still? What do we do from here? Where do we go? Well, we look forward to 2025 at the key factors here. We look at tax policy. So the corporate tax rate reductions will, in fact, be good for some of us. In fact, if you have stocks, it's probably going to be good for you. So financials, industrials, and consumer discretionary probably going to be just fine. You could look at things like Wells Fargo, Bank of America, some bank stocks, consumer discretionary. I like my cheaper consumer discretionary, Dollar General, TJ Marshalls, all of these kinds of things. Fine stocks to own as we head into the new year. Deregulation, energy hasn't done so well this year. Financial and healthcare sectors haven't done well. we'll probably see, like it or not, the regulatory environment start to kind of clear out. And if I was a betting man, and by profession I am, you're going to probably be fine in stocks that are aligned with that story. So fossil fuel, drill baby drill, um, you're probably going to be a-okay. And those stocks also are not heavily bidded up. They're not technology. So you should be in a far better place than you would be if you were just to focus on tech going forward. We have a lot of infrastructure investment that looks to be happening. So if you want to purchase ETFs or focus on individual equities, look no further than your local financial advisor to help you look at equities that might be aligned with infrastructure spending and America First and Trump's America First policy. Um, this just makes us worried about, continue to worry about exposure to the rest of the world. Sadly, diversified portfolio investing has been the bailiwick of any good financial advisor for several decades. But if you're just invested in non-US, or even if you're fully diversified, you know what I'm going to say. It's been tough. And the US looks to continue to be the world's leader, not for any good reasons, but for the reason that it's not doing poorly. So multinational companies are okay, although the text here says multinational companies have risks. What that means to say is if you're really looking to invest in ADRs in non-US companies, could be a tough year. So continue focusing on US. And healthcare reforms, efforts to repeal the Affordable Care Act, it could make it a difficult place to be in the year ahead. A lot of federal contracts are going to start drying up as the government money dries up. And so as we look at to the next year, I'm not going to hit play on this because it's just in poor taste now. But about a month ago, I was in an airport in Germany and I saw this come up on my phone. Can I hit play? I can't play. But if you want to get the deck from me later on, this will be embedded and it's a very funny video. We all thought, oh, maybe President Trump will jump the shark here, but the guy did not. He pulled away and he kicked butt. So yeah, so I mean that this was intended to be just a sort of a primer for conversation. Maybe it will be one-on-one with me, or maybe you have some comments that you'd like to share with the class. Um, in sum total, I'm going to stop sharing. 2025 is looking like a good year, not for the reasons that you may want, but for the reasons, the boring reasons that sum up to gains in investments, which is to say that the macroeconomic data is about as close to perfect as it could be right now. We've got just the right kind of inflation, job numbers, and yes, animal spirits. People are on the chase right now in the stock market to keep things ebullient for at least this next first half of the year. We have to see how the incoming administration continues to balance its story against reality. But it does actually bode well for us as we continue into 2025. Just mind the bouncing ball. Because at Green Ocean, we invest in diversified equities. But there is a world in which inflation spikes. And if inflation spikes, and I haven't prepared any deck for this, but you want to have exposure to real assets as well. I'm thinking things like gold, raw materials, energy directly. And these are, in fact, things that you can gain exposure to. You just have to know how to do it. And so I've been doing the research in case you want to talk with us one-on-one about that too. Otherwise, I am going to open it up to Q&A. I know this is kind of like a Yahoo Finance market talk. There's not as much personal stuff that we could talk about here, but anything that you might have an interest in chatting about, if you want to bring it to us here. Otherwise, I might just I might call it here in a couple of minutes. So just looking through our chat and our question and answer. This is why I don't do as much of these, because it is pretty wonky. I've been reading some books recently that have been, again, sort of consumer finance psychology books that are reassuring but not. The greatest risk that is out there, truly, is ourselves when it comes to investments. The world tends to sort of sail on, whether we like it or not. Somebody here talking about Bitcoin. Whole market funds still reasonable? That's an interesting question that Sally asked. Are whole market funds still reasonable versus individual stocks? That's a great question, and the answer is yes. They are absolutely reasonable. I had an individual investor come to me last quarter, so this was actually a few months ago, showing me their investment portfolio. They had only target date funds, and they looked kind of ashamed, but I'll tell you, owning a target date fund or an index fund is still going to put you heads and shoulders ahead of people that are not diversified in their approach to investing. And so by that I mean there are still people who sold out like right ahead of the dot-com crisis who are sitting on cash. The thing about market timing that nobody wants to talk about is you have to be right twice. You have to be right when you sell just ahead of a calamity, and then you've got to have the nerves when you see the market at a steep discount to go in and buy. And most of us are good at being well, if we're lucky, we're good at one of those things, being an optimist all the time or being a pessimist all the time. Um, oh, I'm glad you guys are in the Q&A because somebody says that the chat was turned off. Sorry about that. So that's a qualified yes, Sally. It is awesome to have funds. It is always a good idea versus individual stocks, unless you have the acumen to choose individual equities. And that takes a little bit of patience and expertise. If Trump gets a dictatorship, are our accounts in the US at risk? Yes, I think that's probably true. But I don't, yeah, again, talking about pessimism versus optimism, like you probably think I'm a damn fool for being optimistic. I think the system's working. I think that's what we just saw with this election was people made a choice. Um, like all choices everywhere, apparently some of us are really psyched about it. Some of us are wondering what the rest of us are thinking. So I don't know. But yes, if the Trump administration were to try something truly radical, then all bets are off with regards to so many things that I have a very hard time picking what to focus on. Somebody's asking about space exploration. I mean, space exploration is interesting. The U.S. is still leading the ongoing space race, and whether you like him or not, it's mostly due to Daddy Elon. It's not his new Department of Government Efficiency, the Doge, but it is their rocket company. If you haven't seen it, you should Google the rocket catch because that company is pretty remarkable, regardless of what you think of their CEO. Somebody has a question here about Bitcoin. I think it was well, the question was, yeah, the Bitcoin thing, which again is probably just a yes, John. I don't understand Bitcoin either. Yeah, Bitcoin is an alternative asset. I've spent a lot of time reading it. I've been told that you have to read about 100 hours worth of material to fully understand it. But I'm sure that that's the same thing that they tell you when you're joining a cult of just about any kind. You've got to really spend time here at the compound. Um, I don't know. Your presentation focused on equities. Do the new circumstances of the coming year suggest any change in fixed income versus equities allocation? That's a fantastic question, Peter. So yes, during this last drawdown, we actually saw fixed income play its its typical role, which is that it provided a shelter to those of us that did not want the the volatility of the equities index. And bonds actually had a problem last year where they were mainly correlated with stocks, which was a scary time. And going forward, it looks like there is a bond recovery afoot, which that recovery just means that they should now be able to play the role that they have played for decades, which is that they provide you with a consistent rate of income. But we still have to be aware of the interest rate environment, and that interest rate environment is that we are going to see interest rates falling by just a little bit, and so we've got to be really short on the stick. You don't want to be purchasing bonds that have, I mean, we buy individual bonds at our firm, and we're looking at anywhere from 3 to 7 year maturities. You just don't want to be exposed to the long end of the yield curve. But yeah, they're safe. They're still the sort of safety play that they have always been, but funds will be a source of volatility as well. Are investments tariff proof? That seems to be in the cards. Well, we can definitely talk about this for a long time, and hopefully we do get a chance to do that soon. Investments are tariff proof to the extent that they are not exposed to the direct impact of the tariffs, which, of course, if you're diversified, you can hopefully stay away from some of those uh, uh, less lucky companies. But the impact of the tariffs, which is inflation, is likely to be mitigated if you do own stocks, because U.S. stocks should actually have a pretty good run ahead of them. And stocks tend to be one of the best ways to defend yourself against inflation, whether we like it or not. Bitcoin talk. Yes, again, come to me one-on-one and we can talk about some interesting books that will help you to understand cryptocurrencies just a little bit better. But suffice to say, it is not as uh, it is not as worked out or as mature a market as the market for U.S. equities or for bonds. We had a question about expatriates. You know, that is not the focus of the call today, although I will say this is that most expatriates from the United States still have the best of both worlds in that they may be outside of the US and leading a less expensive lifestyle, but they still have the opportunity to be involved with the US marketplace because the US marketplace is still by far the most vibrant and robust marketplace in the world. But for specific insights that pertain to you, perhaps, we should probably schedule a one-on-one as well. It's an interesting question that Peter asks. Do S&P 500 index funds adequately capture the potential growth opportunity represented by the S&P 493? Yes and no, but it really depends on which of the index funds that you purchase, because one could actually one could find funds that are constructed in a way that they avoid the top stocks, but that would be, that would be a project. Most index funds reflect the S&P, the Russell 2000, the major benchmarks, and those benchmarks have, as of late, become sort of crowded out by those large mega cap stocks. Okay. Well, I don't want to beat a dead horse or linger at the party. I always tell my wife, let's not be the last people to leave. Although she's such a great person, she always overrules me. But in any event, thank you for joining me. Lots of great questions here in the chat. Um, I think that there is a great deal to look forward to in the new year. I know that for anybody that was not anticipating the outcome of our latest election, they may have some, they may have some consoling to look to from their loved ones, hopefully. But the world it still turns. There's plenty of precedent for what we've just experienced, and there's plenty of precedent for the major moves that the incoming administration looks to be making. So those of us that are engaged with the game will have to play the next hand. So um, So yeah, so cheers to all of you. Thank you for the kind words. I will not be surfing Nazare's big waves because I have a family and my insurance policy is not nearly big enough. Um, yeah, but obrigado. Thank you very much. If you'd like to get a hold of me, as I've said so many times, please do. I'm a social animal, in addition to my nerdy job that I do here every day. So please stay in touch, and I will sign off for now. Take good care. Bye.